Sanctions are supposedly choking Russian oil exports, yet tankers are still sailing, barrels are still moving, and the only thing that really collapses is the credibility of the headlines. Hello everyone, and welcome to the channel. The core trick is very simple. You can ban a pipeline, you can threaten a trader, you can shout about stopping Russian oil to India, but you can't sanction global demand for 100 million barrels per day. The molecules don't care about press releases. They just take a longer route, acquire a new flag, a new owner on paper, and a higher price for everyone else. By the end of this, you'll see why the flows barely change, who actually earns on this chaos, and who pays for the performance at the pump and on the electricity bill. Let's start with the physical side. Russia exports several million barrels of crude and products per day. You cannot just remove that from the market without accepting either a massive price spike or a deep global recession. Officially, the story is we will punish Moscow and buyers like India will help by stepping away. In real numbers, it looks much more like we will pretend buyers step away while the same barrels quietly sail under different labels. Here is where the story stops making sense. One big Western outlet writes about the last supertankers with Russian oil going to India before new sanctions kick in. Sounds dramatic. In practice, the bulk of that trade has been running not on supertankers, but on Aframax-class ships of roughly 600,000 barrels each, shuttling back and forth from Russian ports through straits that simply don't take the largest ships. The logistics are boring, but they are stubborn. On the receiving side, India consumes around 4 million barrels of oil products per day for its own market. Since 2022, it has regularly bought well over 1 million barrels per day of Russian crude at a discount fed into refineries with total capacities tens of millions of tons per year. If you think that entire volume disappears overnight because someone in Washington signed a new sanctions memo, you are very optimistic. There is one number in this story that nobody in Brussels or Washington likes to say out loud. We'll get to it in a moment. First, the incentives. The United States wants two things at once: look tough on Russia and avoid another oil price spike before elections or during a fragile economic phase. So the tool of choice is not a full embargo, but secondary sanctions on shipping, insurance, and companies trading with a couple of big Russian firms. Officially, it is about cutting Kremlin revenues. In reality, it is about forcing the trade into darker, more controllable channels and pushing more demand toward friendly barrels, including American ones. India's incentive is equally clear: cheap feedstock and strategic autonomy. Publicly, it keeps a straight face. We follow our national interest. We respect sanctions regimes that concern us. In practice, if Russian barrels become more toxic on paper, they can be routed through intermediaries, labeled as coming from some unknown Asia, or blended and resold via traders with slightly different business cards. The refinery in India does not care whether the batch is called Russian, Singaporean blend, or just crude. It cares about the netback. China plays a different game. It takes large volumes by pipeline from eastern Siberia and by sea from far eastern ports. ESPO-grade crude has often traded close to or even above Brent because the logistics are efficient and the Chinese don't need a discount on every barrel. They need security of supply. At the same time, they are very happy to watch Western buyers price themselves out of the cheapest flows. And Europe? Europe wants to feel morally clean while continuing to run its economies, so Russian crude disappears from the customs statistics of EU ports, but refined products from India, Turkey, and the Middle East, produced from that same crude, quietly arrive on European shores at a higher margin. Everyone is supposed to believe that this is non-Russian fuel. The system, however, is built around the exact opposite. If you remember only one thing from this video, let it be this: sanctions on oil rarely stop the oil. They mainly reshuffle who earns the middleman premium. Now, that number I mentioned. When analysts track Russian seaborne exports, they separate clear destinations like China, India, Turkey, and then there is a category called unknown Asia or unspecified. Before the sanctions escalated, this bucket might have been around 100,000 barrels per day, just statistical noise. After the pressure increased, this unknown stream swelled toward 1 million barrels per day and more. In some weeks, over 1.3 million barrels per day of Russian crude is heading somewhere in Asia with no clear final buyer listed. This is the part no politician wants to explain on TV. Official narrative: India is cutting Russian purchases. Reality: name flows to India fall and flows to unknown Asia rise by almost the same amount. Maybe there is a new invisible country in the Indian Ocean that nobody told us about. Or more likely, the trade is simply routed through traders, storage hubs, and flags that keep everyone's hands formally clean. If you live in Germany or Poland, ask yourself a simple question. Do you really believe that when your refinery buys diesel from India, it can fully trace whether the underlying crude was Russian, Saudi, or something blended 6 times along the route? Let's bring this down to street level. When the route gets longer, the ship older, and the insurance more creative, costs go up. Shipping Russian oil on shadow fleet tankers that can be switched between shell companies overnight is not free. Somebody pays for the extra days at sea, the sanctions risk premium, the opaque insurance, that somebody is not sitting in a G7 ministry. It is sitting in a truck paying for diesel, in an airline buying jet fuel, in a factory trying to keep margins positive. This is where the spreadsheet quietly turns into social unrest. Take the price gap between Russia and the EU. In recent years, a liter of diesel inside Russia could be around $0.90. In Lithuania or many other EU states, $1.70 and more is normal. Part of that is taxes, part is environmental policy, but in the current setup, there is also a hidden sanction surcharge. And of course, that gap does not just disappear. It creates smuggling incentives, lost fuel from truck tanks, all the usual creative behavior that appears when policy ignores basic arbitrage. From Vilnius or Brussels, measures like limiting how much diesel a truck can bring over the border look like closing loopholes. From the point of view of a driver, it looks like the state protecting its own high-tax fuel market and forcing everyone to pay for the political stance in their daily operating costs. For small logistics firms already squeezed by high rates, this is not a theory. It is the line between survival and closing the business. If you work in transport or industry, you probably see this earlier than everyone else. On the Russian side, the picture is also not heroic. Even with discounts, the state budget wants its share. A large part of oil revenue comes from mineral extraction taxes tied to reference prices, not just from export duties. Domestic fuel prices move up whenever internal consumption spikes or exports become more profitable. The result is that the supposed punishment of Moscow turns into a combination of discounts for Asian buyers, extra profits for shadow intermediaries, and very real inflation pressure for Russian households as well. Everyone is supposed to believe that sanctions are a clean moral instrument. The system, however, is built around maintaining flows and shifting costs downward. Globally, the more we move toward this kind of fragmented market, the more bargaining power shifts from official institutions to those who control logistics, gray fleets, and financial plumbing. That includes some Western traders, some Gulf intermediaries, some Asian buyers, and a whole ecosystem of offshore companies and flags of convenience. Small states in Europe talk loudly, but their real function is often reduced to giving up transit fees, paying higher energy prices, and then being told to be proud of their values. From your country, does this look like strategy or just improvisation with a flag on top? For the average person, whether in Lithuania, Germany, India, or Turkey, the pattern is depressingly similar. Energy bills fluctuate more. Taxes creep upward to fund compensation packages and support measures. Inflation eats any wage growth. And at the same time, people are told that they have sacrificed something significant while the physical system has barely blinked. In the end, Russian oil still flows, India still refines, China still buys, the West still consumes. Only the map of routes looks uglier, the paperwork is thicker, and the margin is captured further away from the citizen who finances it all. Thank you for watching. Take care of yourselves and your loved ones, and try to remember, slogans don't power grids, systems do.